Okay, good afternoon, everybody. And this is Option Professor Market Weekly Update. And this is for September the 14th, 2018. As always, we do every week update you on all the different markets. And we also remind you that past performance is not necessarily indicative of future results. And we also remind you that short-term trading, option trading does involve substantial risk of loss, and it's not right for everybody. So check in with your financial advisor and your good common sense, and make sure that any of these things we talk about may or may not be appropriate for you. You have to find out if they are or not. Again, I'll give you all my opinions and views here today, and that's what they are, my opinions and views. The stock market today and this week has been rising, but today did roll over at around midday East Coast time. And the reason for that is that Mr. Trump has announced that he is thinking of moving forward with $200 billion more of tariffs on China. And the market didn't care for that too much. So it went from 26,200 area on the Dow, and now it is currently in the 26,080 area. So it looked like it gave up almost a couple hundred points when that news came out. Same thing with the NASDAQ. It was at 8,040 area, and it's down at 79.88 now. So there's been a little bit of a reversal here on a Friday with the announcement of the indication that tariffs might be going on China. I don't think the markets like that type of aggressive talk. At any rate, what I would like to do today is go over a couple things that are going on right now. We have got a situation that some news came out this week on the CPI. The Consumer Price Index. It was pretty mellow. Medical cost and apparel slipped. Modest movements there, and modest declines, I guess, in food. Basically, at the end of the day, housing was showing a little bit of weakness as well, and energy softened a little bit as well. So the CPI is indicating that the Fed, it does not have to hit the urgency button as far as their hiking schedule is concerned. And while the hike this month in September is viewed as a certainty, the September hike is high probability, but then as you go into next year, it's going to be data sensitive, data dependent. So the CPI is not indicating any wild inflation happening. The wages did increase in the last unemployment report. That's something to keep an eye on. You would think that all the tax cuts and all the repatriation money might see their way to some of the employees. So far, that's been slow to come. But if that pace picks up, that would be a substantial thing to keep an eye on, because the bond market with 2% interest rates and that kind of thing is not really factoring in any inflation at all. And if the inflation were to pick up substantially, the bond market could get whacked pretty hard. With regards to other things that came out this week, just as a quick review, retail sales came out today. Upward revision, very strong retail sales in July, solid pace for Q3's consumer spending. Consumer spending is about 2/3 of economic growth, so it's very important, and it looked like July was pretty big. August slowed down a little bit here, but that sometimes is common because of it being the end of the summer. Non-retail stores, did see pretty good positives. That's your e-commerce. So that e-commerce continues to eat into the brick and mortar guys and continues to do that at a pretty good pace. Gas stations were up a little bit as the pump prices went up, and the restaurants are pretty strong. So that's why when you go out to eat and there's an hour wait, that's obviously giving you a good indication of people going out and spending money at the restaurants. After that, retail sales came. By the way, there was weakness in autos, furniture, building materials, which may circle over into something negative in the housing situation with regards to the slowness in building materials. Import-export prices fell, and that was a little bit of a surprise, but they did see some falling. Finished exports were weak. Agricultural exports got weak. They went into a big front-running thing last time, and now they think like that's kind of bad news for the farmers. So the farmers are still pretty stuck in the middle of this trade war thing, and that's not a good thing. Other things that happened today, on the retail sales, industrial production, auto production was up, mining is up. So they seem to be doing a lot of mining, and utility also were up. So industrial production was doing pretty good. High tech business and business equipment did pretty good. Just checking a Deere. Let's see what Deere did. That would be business equipment and industrial commitment, and that stock is down today. But as you can see from the chart, it had a little bit of a rally from the 135 area to 150, so that might be one of the reasons behind it is the little pickup in the industrial equipment area. What else is going on here? Business inventories started Q3 very strong. There's a big lag between the inventories and the sales. Right now, the differential is still pretty wide with 4.3 for inventories and sales at 8.1. So inventories do have to pick up to meet sales, and that's a very good sign for GDP and employment. So these numbers are strong, and if we would stop probably the tariff talk or resolve some of the tariff talk, this market could get a tailwind that would be very, very substantial. Consumer sentiment is very strong. It's over 100.8. So the strongest since March. And before March, it's the strongest since 2004. So we're talking about some very big consumer confidence out there. And it is expected to translate into a very strong consumer spending number for September. It's back to school. And when you go back to school, people load up on a lot of spending for clothes and supplies and all kinds of stuff. So it could be a good consumer spending number for September. And of course, that's a nice tailwind for the markets as well. It also, the inflation expectations on consumer sentiment was low. And so that is another reason, in addition to the CPI, where the Fed doesn't have to hit the panic button. And as you can see here, let me get up here and give you the 10-year note, which we can get into in a little bit anyway. But you can see that the 10-year Treasury is still having a tough time getting above that 3% area. It's at 2.98, so it's sniffing around it. There's your chart right there in front of you. You can see if I move the chart up a little bit, you can get the dates right there. And you can see that this thing has been in a trading range of about 280 and 3, right? And that trading range started after it broke above 3. There's still a gap there, right around 3.05, I guess. But you can see that it's been in that 3% to 2.8% since May. So when that thing breaks out, either up or down, meaning above 3 or under 2.8, if you measure the width of that trading range, you could get a substantial move out of this area. If we get tremendous consumer spending, if we get great employment numbers, if we get great GDP, and if they start increasing wages at any level, you would think that the bust out above 3% could be rather substantial. Conversely, if all these things that people are optimistic that's going to happen goes the other way, then this thing could fade off of the 3% number. A lot of people are very, very complacent here with a lot of things. They're complacent with the stock market up at these levels. They're complacent with the bond market at these levels. And complacency sometimes is not the way to go. There's that old adage, don't sell a quiet market. And so if that's the way it's going to be, yields could bust above 3 and the stock market could get that big rally that they're talking about in the fourth quarter. A lot of people are talking about this 10% melt up possibility. Only time will tell. Next week, we do have housing in the news. Housing starts and also housing existing home sales. So we'll be getting a lot more news on that Thursday and Wednesday of next week. And Friday is triple witching, which means you've got expirations coming up in futures and stock options and the indexes as well. Let me just take a look at KB Homes and see what's going on with them and if that's been affecting, because it sounds like some of the numbers are saying that there's been a little bit of a slowdown here in the housing situation. And this stock here, KB Homes, would be evidence of that. In the last year, we've gone from 38 down to as low as 20, bounced back up here to 26. So if these numbers on housing starts fading, again, there could be additional pressure here. If they pick up, maybe this thing is trying to make a turn down here. Let's take a look on KB Homes at the moving averages and see if there's any evidence of a turn here. Residential building construction, right? Well, Let's see what you've got. You've got the 50-day at 24, so it's above the 50-day, and it's under the 200-day at 28. So it's kind of in a rock and a hard spot between the 50 and the 200-day right now. Volume has been kind of light down here, but moves above. It's at 25 and a half, moves above 28, and staying above 28. Might be an indication that it could be turning. And likewise, if it starts fading underneath the 50-day of 24 and a half, that wouldn't be a good sign because it's already in a negative connotation, right? You've got the 50-day under the 200-day, which technically is not really where you want to be. Let's look at another one, Pulte Homes, and see if there's anything going on there. And that is PHM. Okay, so let's take a look at Pulte Homes real quick and give you an idea of what's going on there. A similar story, so no surprise. Pretty much earlier in the year, you were way up where you near 40, 35 area, 36, and now you're down at 26 area. Again, is there a turn down here? Hard to say. These numbers that are coming up now next week will probably have an effect on this stuff. But certainly these stocks have been on the defensive, huh? Okay, what I'd like to do here is start out by going through a few of the different markets here. I had taken some notes on the various markets, and I'm just going to refer to them now. Let's turn quickly here to some of the things that I've been watching in the market here. The semiconductors, okay? SMH or SOXX, or a couple of indexes on that. Let's look at SMH and see, because I thought there might have been a big reversal here. You see that island there? That's an island reversal. You see it's an island on SMH. And so that could be a situation where it could be a turn. So I'd keep an eye on that. As long as it stays above that 105 area and keeps matriculating higher, I'm looking at that island as a very significant situation. I'll show you another semiconductor here, and that'll be the SOX, SOXX. It's actually bigger than this one I just showed you. This is from iShares, and it's the Philly Semiconductor, and you can see there's the island, right? So that's sometimes a very, very powerful turn of events here. So keep an eye on that. As you can see, it gapped up yesterday and formed that island, and now it's up again today. Now, one of the stocks that this Mr. Tepper, I guess, was on the TV talking about is Micron Technology. And the real star in this thing has been Advanced Micro Devices. But this one here is worth taking a little look at because it had a big drop, right? And it dropped way down to about 40 bucks. Now it's at around 43, 44. PE ratio is obviously dirt cheap. And there is a gap there just under 50. So I don't know if it's going to go up there or not. But with the island reversal in the actual index, not index, but the ETF, this would be something to keep an eye on, and a fairly well-heeled investor, Mr. Tepper, remains somewhat constructive on it. So keep an eye on that, and that might be of interest for you to keep an eye on as well. With regards to other things that are going on now, Apple had the big show this week. Let's see what's happened here on Apple. It seems to, again, I would be concerned about Apple maybe having a rollover effect here if it can't take out this high of 230 and it happens to take out that reaction low there of about 216. Someone could make a case that we could go back into the 180, 190 area, which is where all the support is in that big gap. You see that gap right there, 190 and change. So if the winds of change were to blow, and again, they just came out with their news. So if it was buy the rumor, sell the fact, this would be an area where it could roll over. If you own Apple now, you might not want to sell it because obviously you're trying to be a long-term holder. But what might be a good idea is to investigate covered call writing. Obviously, with the prices way up here, the 240, 250, 260 calls might be something to take a look at. And then, of course, when you sell a call, you're going to receive cash, and you are going to be agreeing to sell your stock at the strike price until the option expires. Now, what you could do when you sell the call option is you can take that premium and use it to buy a put. And that puts parameters around your stock. So if it drops down to 180 and you've sold the call at, say, 250 or 240 and took the premium and bought a 215 or 210 put, you'd have a floor under it at 215 or 210, whatever strike price you choose. And then if it goes down to 180, 190, at least it would offset the risk going between the strike price and where it would end up. Of course, if it stays flat, the call option goes to zero. And if you spent only what you took in net on the put, then it's a wash. The call paid for the put, and you still own the stock. Again, there's a lot to learn on the collar strategy, which is the one that I just mentioned. And the Option Professor DVDs certainly cover these in great detail. I always say every week, if you have any questions, if you'd like to know, if you have a personal situation, you'd like to ask a question of me, I'm more than happy to help. You just shoot me an email at optionprofessor@gmail.com. So it's very easy to keep a hold of to get a hold of me and give me any pointed questions you might have. Again, I'm Jim Kenny, and I'm more than happy to give you a hand with information that might expand your knowledge, and then of course maybe help you in some way, shape, or form. Okay, so there's the story on Apple, and again. They had something from Breitbart on TV that had the head of Google talking about how he wasn't very happy with the election. And so I didn't think that was very good for Google. Let's see how's Google doing. Because there is a lot of talk now that, the antitrust people, monopoly people are coming out of the woodworks, Jeff Sessions, a couple of the different senators or and so these guys don't want a lot of heat on them because they are all data companies, Google, Facebook, etc., Amazon. They're heavy into data, and if they started putting a lot of parameters or crimps on their styles, it could affect their advertising, and it could affect their revenues, and that wouldn't be very good. So anyway, Alphabet again has problems up here at 1250. And it has been backing off that 1250 number. And right now it is down about $4.50, but it's about $10 off the high for today. Let's look at the moving averages on Google so you can just take an idea of what's going on here. And the moving average is down 1109. So 200-day average is 1109. And you're way up here at 1170. So there is some real estate between here and the moving averages. So I don't know if it'll back and fill here for a while, but it very well might. Keep an eye on that. Again, when it's up in the 1250 area or where your Amazons, what I've told people about on this broadcast is when, Amazon goes up to 2050 and the moving averages are way down. Let me show you where they are to get an idea what overbought looks like. Hold on. Let me just, give you the, we're at 1557. And so when you're up at 2050, you're $500 above the moving average. And that's very far away from the moving average. And that's why I think technically thinking that it might pull back made a lot of sense. So what do you do when you're up at 2050? And if you own the stock, maybe you do some covered call writing, sell the 2100 call, maybe buy the put at 2000 and see if you can collar it. And so when it drops to 1963, or if it goes down further, you're still, like I say, $400 away from the 200-day average. To say that there's no real estate between here and where the moving averages are is not right. So again, the collar strategy comes in very handy. If you're not sure about how it works, again, OptionProfessor@gmail.com. Shoot the question over, and I'll give you a hand with it. Okay, so again, tech seems to be rolling over a bit here, and some people were talking about the oil markets because the Brent crude, I guess, went up to 80, and XOP, of course, is your oil and gas exploration. And there are some who believe the dollar might be rolling over, which I'll get to in a minute. And of course, if that happens and the oil gets running above 70, you really need it to get above 71, 72 and stay there in our West Texas Brent our West Texas crude to get the prices really turning up to the upside. If that happens, I would imagine that this XOP may benefit. So keep an eye on that. If it gets above this 43 area, you've got a nice 1, 2, 3 formation, 1, 2 on the pullback, and then the 3 takes out 43 if it can get legs. And again, looking at the moving averages on it right now, let's take a look at those. and you're seeing 38 and 41, so they're inverted to the upside. That's not bad. And then basically you're trading at 41. So, as long as this stays above that 38 to 40 level, I'd be constructive on this. And if it takes out 43, I think you might be off to the races. So keep an eye on XOP if you're an oil person, and that might not be a bad one to keep an eye on. The other one is, if the stock market is going to roll, I mean, if the dollar is going to roll over a little bit, as some people say, fourth quarter, they're looking for the dollar to roll over. I was a believer that 115 was going to be the bottom of the euro. It went down to about 113, 114, so I was a little bit off on that. But now it's trading 117, and it looks like it might have turned. So keep an eye on the euro staying above 115 and maybe working its way back towards 122 in the fourth quarter. And if the dollar does roll over a little bit, gold did hit 1160. And if you look at GDX, these gold mining shares are very much down and near their lows. So obviously, if it pulls back here and cannot take out the 1728, which is the 52-week low, there could be a move towards that resistance of 21 if the dollar got weaker in the fourth quarter. And if maybe the inflation picks up a little bit, that would be the double whammy to maybe get a short covering rally here at least. And again, you see all those lows that broke at 21? That would be the neighborhood where it might be able to turn towards. So keep an eye on that because, you always have to try to skate to where the puck's going to be. Right now, the puck looks pretty lousy in the gold and not so great in the oil. But if the puck's going to turn, that's a potential. So you want to keep an eye on that as well. Some of the other sectors out there, the industrials, I've been watching this VIS, which is the ETF out of Vanguard for the industrials, and it definitely has been trying to turn up, as you can see. So the industrials seem to be getting the money that's coming out of tech. And oil and the industrials seem to be two that might be a good thing to keep an eye on. Looking at the detailed quotes on this particular ETF, and of course there are others, the industrial sector has had it's right there. The moving averages are on the process of trying to invert. They're right around the 141 area. We're trading 148, 149. So if the market has any pullbacks and it holds this 140, 141 area, this might be worthwhile to see. It's also approaching a resistance zone at that 150 area. It's been in this range all year long, 135 to 150. So if it breaks above 150, that would be, the high is 151 right there. So if it breaks above 151, there's not much resistance above there, is there? So keep an eye on the industrials. If it can get some more legs, it could have some future. Another sector everyone keeps pounding on is the financials, but boy, they don't seem to be able to get going. XLF, of course, is a ETF for the financials. And those are your banks: J.P. Morgan, Bank of America, Wells Fargo, you know the names. As you can see, it's been sitting there, sitting there, sitting there. If it can get above 29, obviously that would be a very good sign. Let's look at what the moving averages are doing. Moving averages on the financials are 2740, 2790. We're at 28. So it's all clustered here, right? Looks like it's having a hard time at 30. It's been trading between 25 and 30 all year long. But certainly it is a little bit directionless. So I would be a little bit careful here. And there could be another move to the downside if circumstances like these tariffs that he's talking about start accelerating. Because, tariffs can hurt GDP and it can cause some inflation. And both of those things would not be, I don't think, market positive. So keep an eye on the saber rattling with these tariff talks. And hopefully the sabers will stay in their holsters, because if they come out and they start pointing it at each other, it could be a tough racket. So keep an eye on that. All right, so we went over a few different sectors here, and I think what I'd like to do now is briefly go over a couple more. We did go over the S&P 500, but I'll go over it again for you so you can take a look. This is the broad-based S&P. And where are you here? There you go. It's right there at the high, double high right there. So, if it starts breaking that low of 2860, that was last week's low. I think you're going to be able to test the 2800 area. So be careful if it gets underneath 2860. And if it does break 2800 for whatever reason, the next level down is the 200-day moving average area, which I believe comes in around 2700 or so. Or actually, I think last month's low or something like that. But you can see 2700 there was a low point. So where are your three lines in the sand right now? One is 2860. The next one's 2800, and the next one's 2700. And you see, if it does start to break and this tariff thing gets out of hand, you could see it moving higher. The VIX has been under control, cannot get above 15. So if you start seeing a VIX of 16 or 17 for whatever reason, it's probably because the market is rolling over to the downside, and you got to be careful at that point. So the VIX right now is at 12. You can see it at 1190, very much down near the lows. You can see the 15 mark. It has been holding there for pretty much the whole year. Let's see here. Well, not for the whole year. It did have that spike up in June. But since June, so that's 1, 2, 3 months or so, it's been having a hard time getting above 15. That's why I say if you start seeing it trading 16, 17, and you start seeing the S&P breaking under 2860 and then 2800, then the correction would be very significant. Right now, there's no evidence of that. But, you know, if you don't ever look for your umbrella and your raincoat, you're going to be pretty panicked when it starts raining, if it does start raining. It's always nice to know how those things work before the rain hits, right? That's why I always try to tell people, learn about the hedging with the collar and the married puts, because they come in handy. And even hedging when you're doing your trading, because a lot of people will find you're either very wrong or very right on your trading. And having a little bit of a hedge on a weekly call or a weekly put going against your primary position is not the worst thing in the world. Your position should have enough juice in it, meaning potential profit, to cover a small premium. If it doesn't, maybe it's not a worthwhile trade. And then that little premium you put on there may be a very big factor on keeping your balance stable if you are totally wrong on your position. Again, OptionProfessor@gmail.com. Shoot your question over, and we can communicate that way. One thing I did want to show you is something on a long-term bond graph that looks concerning to me. VBTLX is a Vanguard ETF, and it is a big one. And I'm going to put the 10-year graph on here because it gives you a longer term perspective. And I think in this particular situation that we're in, a long-term perspective is not the worst thing to see. So let's take a look at it here on a 10-year graph, and you can see that this thing has been on the defensive. When interest rates rise, bonds go down. That's the way it works. Okay, and so basically rates have been rising, so this thing's been coming down. The thing that I find important, that it has been very difficult to get above the 1050 mark, and the graph looks like it's pointing to the downside. So an acceleration to the downside may very well happen. And if that were to happen, it would probably coincide with a jump in this 10-year treasury. Doesn't have to. This is my opinion and my view. But if if that thing is going to accelerate to the downside, then I think this 3% is going to break, and we could even go up to 3.5 quickly if in the fourth quarter these numbers are positive and you get a big spike up in consumer spending, inflationary numbers, and the dollar weakens, etc. So keep an eye on that, because I think the fireworks could start hitting in the fourth quarter in the treasury and in the fixed income market. You people that are in fixed income, a lot of people are saying stay short term. You know, today we almost went to 3% on a 5-year treasury. That's 3% guaranteed by the government for the next 5 years. Those yields are going to start attracting people, particularly people that are above the age of 50, who don't really want to gamble with their life savings anymore, hoping the stock market never drops. They could start taking money off the table in stocks and transferring it over into fixed income if those yields get juicy enough. That's why you got to keep an eye on that. Other things that are going on is, again, the dollar. I wanted to show you real quick. And there you go on the dollar index. And as you can see, like I told you, it had a big run up, and now it has hit that area of 96, 97, and now it's starting to show a little signs of cracks in the armor. If you were to take out the 94, 93 area, then that move to 97 will start looking a lot more like a temporary top there than it does right now. Right now, it just looks like it's coming off a little bit. Still pretty high, still pretty strong. But I would say that, again, if we do start seeing it, and again, you can see why 95 would have been resistance, or 97. There's a lot of activity there in the years of 2000. Let me see here. Let me get this for you here real quick. Okay, yeah, in the years of 2015, 2016, that was the low of the dollar, right? And so now that it's come up and it's rolling over from around that neighborhood, if it does start rolling over, that means that resistance could not get taken out. Okay. All right. Well, I would like to say this to everybody. We are going to wrap up right now. If you have an interest or a question in any of the areas that I discussed, and I certainly went over quite a bit, the stock market, the bond market, the gold and silver markets, the oil markets, and others, plus some sectors I talked about, shoot me an email at OptionProfessor. That's OptionProfessor.com. Shoot me at gmail.com. So it's optionprofessor@gmail.com. And shoot me an email so we can go over any of the specific questions you have, or you'd like to hear any of my other ideas that I haven't been able to cover today. Until next week, I wanted to wish you all the best and good luck on all your trading. I'll be back with you next Friday with the weekly update. Until then, good luck and good trading, everybody.